Goedemiddag, welkom bij deze breakout sessie van het Pensioenpro Beleggingsberaad, wat vandaag volledig in het teken staat van klimaatbeleggingen. We hebben in deze sessie twee sprekers. In het eerste half uur spreken we met Oliver MacArthur van E.ON. Hij is daar Impact Investment Lead en hij gaat spreken met ons over impact investing in beursgenoteerde aandelen. Daarna krijgen we twee sprekers van HSBC. En zij gaan het met ons hebben over het financieren van bedrijven die zich bezighouden met de energietransitie. We beginnen zo meteen eerst met E.ON. Misschien hebben we onze spreker al beschikbaar hier, Oliver.
Good afternoon.
Hi Oliver, welcome to this session. U kunt gedurende de sessie vragen stellen. Er is een venster beneden in uw scherm, een chatvenster. Daar kunt u de vragen stellen. Ik kan dat scherm ook zien. Dus ik zal af en toe een blik op mijn laptop werpen en dan kan ik die vragen aan Oliver voor u stellen. We zullen op 2 momenten tijdens de presentatie daar pauzes voor nemen. Dus stel vooral die vragen. All right, Oliver. Well then, I've just introduced you in Dutch.
Good afternoon. Thank you for the kind introduction, I think.
It was kind. The floor is yours. Please enlighten us with your insights about impact investing.
Very good. Well, thanks again for the introduction. I'm disappointed we couldn't be together in person today, but it's a privilege to talk about impact investing this afternoon. So best place to start is probably on the first slide, just really highlighting the cacophony of challenges that face us today. And that's really highlighted with the fact we're talking virtually today as a result of the global coronavirus pandemic. But that's also, unfortunately, creates the backdrop of severe economic damage, recession, and really highlighting resource scarcity and really unequal outcomes for people as a result of this pandemic. And that's highlighted through dangerous mental health effects of lockdowns, increased evidence, social inequalities, rise in voice of protest, and that's set against the backdrop of insidious climate change and biodiversity loss. So this is all happening at pace. The effects are interlocking. It's hard to predict what those effects will be across society and environment, and those implications are only just beginning to become evident. So I suppose it's not very often you see quotes from Lenin in an impact investing breakout session, but it really does feel at the moment that the weeks feel like decades and decades feel like weeks in terms of what happens. So that's really perhaps the troubling backdrop to start with. And I think that the easy position there is really to be despondent as a result of that. That's very clear. But I also think it gives us cause for optimism. I think that's really evidence on the next slide about how that optimism believes that we can lay the foundations and use this crisis to build on future opportunities, not to return to the business as usual that we had previously or the old normal, but a vision of a cleaner and greener future, which really comes out very neatly with Adair Turner's quote there, highlighting the need to rebuild economies that have been hit hard by coronavirus and build back in a way that's healthier, more resilient to future shocks, and fairer to a wider range of people. Now we put some of those terms there that we're seeing in the market today around new normal, build back better, future we want. They all sound neat, but I think the real challenge there is about using this crisis as a way to deliver better outcomes for people and planet. And that's why I think impact investing comes in, and particularly in a public equity context. So talk about a bit more on the next slide, and I guess using that as a segue, really just reiterating the challenges that I highlighted earlier around climate change, resource scarcity, social inequalities, and these are big global challenges that face us, and we need enormous amounts of capital to shift the dial on those challenges and rise to the challenge of these global issues. And that's really encapsulated by the Sustainable Development Goals, which is the shared blueprint for peace and prosperity for people and the planet by 2030. And what's stark to me on that point is the $2.5 trillion annual financing gap to achieve those goals. And I think it's becoming increasingly clear that governments must move away from a confined project by project approach on working towards these goals to a more holistic financing strategy that uses all sorts of capital from across the various stages of the investment value chain. And that's where liquid markets come in, really. So those large liquid public markets are required and needed to respond to the scale of these challenges, alongside, of course, those targeted private market impact investments that perhaps known more historically. So that's really the thesis there around the combination of the public policy envelope that faced us today and the change in market landscape. That creates the need for adaptation and innovation, primarily driven by shifts in changing consumer preferences, the rise of conscious consumption, and increasingly muscular regulation. So most regions today are really pushing forward the sustainable finance agenda, certainly in the European Union, in the UK, perhaps less so in the US, but generally there is a tailwind around regulation, and that's set against the backdrop of technological change leading to winners and losers likely to emerge. So corporate that can respond robustly to the challenges of sustainability, using sustainability insights to think holistically about risk and opportunities, and those investors that back those companies that can see how that as well evolve, in our view, differentiated returns in the long run, but also contribute to measurable positive and environmental change, social change. So I'll pause there for any questions.
Yeah, thank you, Oliver. Yeah, there was a question. I always like it when somebody comes up with slides with Lenin quotes. Lenin, I think, obviously, when he talked about decades are passing in weeks, he must have been referring to the Russian Revolution at that point. That was triggered by a major crisis as well, by the First World War. And the result was socialism. Maybe perhaps it's not a coincidence that, let's say, a larger role for government is currently also being discussed in terms of this crisis. So do you think, you talked about the contribution of private capital, but how about public capital? Don't we need more government at times like these, like Lenin would have said?
Well, I think that you're absolutely right in terms of need an active state and a strategic state to support the recovery. I think you've seen that very clearly in terms of the response, certainly in the UK and the European Union, that have been very active to support and step in when private markets are unable to do so. But I think the challenges that face us are not confined to governments alone. And perhaps we've touched on later in the presentation that investors, capital markets can make change, positive change. And also that's really thinking about long-term returns too. So it's not coming necessarily from a charitable place. It's coming from the fact that the social license to operate for companies is changing, consumer preferences are changing, companies need to adapt, and the way to adapt to that change in planet change in market environment is to become more orientated around sustainability, think about both the harm of the companies created but also the positive impact too. So I think it's a challenge for everyone really, but I think we need strong backing from government, of course, but also very active and forward-thinking moves from capital markets investors, which I think is definitely on the way, and it's only just accelerating.
Yeah, but do you think all challenges can be met by private capital? Because you might not be able to be sustainable and turn a profit at the same time, or.
I think that's entirely fair. I think there's around impact investing, particularly there's a spectrum of capital. So you have concessionary investments, or actually start from philanthropy where you don't seek any profit at all. You just seek maximum social impact, and then you move to concessionary impact investments where you have a low expectation of financial return, but very high expectation around social impact. And then you move along that spectrum to having more market rate returns. And then, so I think it's a spectrum. So I think investors do have a role to play. And I think from my perspective, it's coming from a positive place. Obviously, business needs to be constructed responsibly. But I think positively they have a strong role to play, and I think of course we need a strong government, but capital markets are also a very important part of that too.
All right. Well, since there are no audience questions at this moment, so perhaps we'll move on to your next slide. I'll press the button for you there.
Very good. Thank you very much. So so I guess thinking about impact investing, list equity in a bit more detail. Probably the principal starting point is using equity finance to support purpose-led companies that are delivering solutions to environmental and social challenges. So the idea here is to generate a kind of win-win inverted commas for shareholders, while also contributing to solutions to those challenges. So typical areas of interest for impact investors in listed markets from an environmental angle would be energy efficiency, water solutions, pollution mitigation, and renewable energy. And if you're more interested in social goals, then those key areas of interest likely to be education, financial inclusion, basic needs, and more sustainable forms of production. So that's really kind of the more thematic angle around impact investing in listed equity context. And I don't want to dive into the kind of theories today, but I think it's best to bring it to life with a few real life examples and companies. So first one there is Umicore, which is a Belgian company. It's involved in the electric vehicle value chain, particular focus on battery recycling. And so the value proposition there is particularly around reducing the need for mining, reducing the need for primary resource extraction, and then seeking to deliver better recycling. And that's particularly juxtaposed against the challenges around sourcing of cobalt, which is in the primarily from the Democratic Republic of Congo, which is a very difficult area to operate, and significant dangers there around artisanal mining, use of modern slavery, for example. So there's a clear value proposition there where you're seeing good financial returns, but also better stakeholder outcomes. That's Umicore. Second example is Beyond Meat. So that's a US company. Probably you can tell by the name, it's seeking to profit and scale meat alternatives, which are obviously critical to fighting climate change and biodiversity loss. Lots of issues around methane gas generated by meat production, use of land for agricultural activities, lots of issues around fertilizers. So this is a very much, again, an angle where you're seeing a very profitable total addressable market in the long run, but also delivering against some of those environmental challenges, which are obviously critical. And speaking on the environmental challenges, moving on to Ørsted, it's emerged as one of the world's first renewable super majors. So delivering renewable energy at scale to help provide that kind of cleaner, greener future. So that's been really, really positive from that perspective. And then latterly, Moderna, which is a US biotech company, which is developing one of the potential COVID-19 vaccines to fight the pandemic. So this obviously, these examples that we've selected for this case study is many more examples of how businesses can use how you can use business models and the sustainable transition to support social and environmental impact. I think that's a key question there is around there's no perfect company. There's lots of shades of grey around the business structure, business models, business practices. So I think impact investors obviously have to be very careful on how they target companies. But again, you can invest in listed companies and seek to deliver environmental positive outcomes and social positive outcomes too. So that's that's the solutions. I'm happy to take questions on that or speak more in a bit more detail about
after this slide.
Oh, very good, very good. Okay. Excellent. So so that's the first angle, is just around financing purpose-led companies. And I think actually there's a broader opportunity, perhaps underappreciated opportunity around using engagement and the tools of active ownership to drive better environmental and social outcomes. So what does that mean in practice? So engagement can encourage the superior stewardship of environmental assets, promote, align the company with the sustainable development goals, reinforcing the importance of long-term value creation and how that aligns with both the returns that the company needs to generate for shareholders, but also its social license to operate in the context of a changing world. And then latterly, building out disclosure that the market can use to make better decisions on backing sustainable companies and reducing capital for companies that are viewed as unsustainable in the long run. So we thought, again, best to bring it to life with a real-life example. So we thought we'd use a well-known company that's well-known in the UK and the Netherlands. So that's Shell. I just really wanted to highlight there some of the very positive steps taken recently to realign the business model to a more sustainable future. And that was a function of deep discussions and engagement conducted by the Climate Action 100+ initiative, which is an investor coalition aiming to ensure the world's largest greenhouse emitters take the necessary action on climate change. So Shell in itself is responsible for around 70 million tons of CO2 in 2019, and that's just in its own operations. But I think more broadly about what its products and services are used for. Obviously has a big system-wide effect in terms of carbon emissions. So I thought it was really powerful to see the commitment to be the net carbon footprint to be zero by 2050, with clear links to executive remuneration targets, as well as committing to disclosures in line with the Task Force for Climate-Related Financial Disclosures. So again, we thought that's a good example of how investors can achieve impact from engagement, and that leading to better environmental outcomes. So both you've got firstly those investing in purpose-led businesses, where you've got very clear alignment between the business model and environmental and social outcomes, and then secondly, using the tools of active ownership to change business models over time.
All right, thank you. Well, we have an audience question right here. It's from Mark Hutton, and he asked, what is your view on the definition of impact investing and public equities? So those two terms in the context of sustainable finance disclosure regulation.
Very good. Well, yeah. So impact investing. I suppose the history of impact investing is from a private markets context, where very much project by project approach, where there's a clear theory of change. For example, I think there's a hypothetical example that often uses around there's a resource constrained area that's lacking water. There's a clear impact investment thesis around a water treatment plant, which delivers very robust, resilient long-term cash flows, whilst also delivering clear, better environmental outcomes in the provision of better water quality for local people. So that's really the hypothetical example around private market impact investing. And that of course is very critical to the broad thesis of impact investing. And talking about what you have there is clear intentionality about the impact that you want to achieve, and then latterly the additional capital that your investment has provided that wouldn't have been there otherwise. So that's obviously the historic definition of impact investing. With the impact investing in listed equity context, obviously you're trading shares on a secondary market, so perhaps you don't have that as clear additionality link, but certainly, as we've highlighted, by using equity finance to support solution-led businesses and provide capital, companies use tools of engagement to lead to better outcomes. That, as we saw with the Shell example, and I think and impact investing in liquid equity is a very strong force for good. I think it should be encouraged, and I think that's been borne out with some of the rapid growth that we're seeing in impact investing in listed equity context.
Okay, well, thank you. There's a follow-up from Mark, actually. How to measure and report impact in public markets as an asset owner? Yeah.
Well, we've actually got a slide on that on the next one. So happy to.
Okay, well, we can actually move on to that slide. Why not? There we go.
Very good. So that's obviously a very pertinent question about impact measurement. So thanks for that. As if it was a prompted question to lead to the next slide.
No,
so
it was
really do appreciate that. So obviously, key question for impact investors is how do you measure the impact? So I think certainly in listed markets, what we've seen is the Sustainable Development Goals have emerged as the umbrella framework for impact investors, and that's where there's a particularly broad impact remit. So we've just shown an example on the slide of some exemplar impact measurement. So what we're seeing really is how you can map companies in the portfolio to the various sustainable development goals, usually aligned with how the company generates its revenue. And that can typically range from 20 to 50% of revenue, trying to relate those to the sustainable development goals. So for example, many of the companies that are deployed in these funds are kind of mid to small caps. So they're typically focused business models. So you can see, for example, that Ørsted has a clear anchoring around SDG 13 and the other climate goals as well. So I think that's particularly evident when you look at those mid and small cap companies. When you have larger, more conglomerate companies, it can be a bit more tricky. So that's what we're bringing out in terms of the broad SDG alignment. That's something we see is becoming increasingly evident when we look at a lot of funds operating in the space. Aside of that, there's a number of industry initiatives such as the Impact Management Project, the Global Impact Investment Network's IRIS Plus project around how the market coalesces a standard of impact measurement, of which obviously there is no market standard right now. Lots of questions have been raised previously about ESG data issues, whereas in the impact world, those data issues are even more magnified in terms of lack of disclosure, lack of common standards. So there's a lot of work to do that the industry is certainly thinking about, but very much on the early stages of that. And on the latter point around those engagement stories, which are particularly anchored around engagement. So naturally you provide the full suite of voting and engagement records, evidence of how the investor has encouraged and supported change at the company and how that's led to improved environmental and social outcomes. So both got the SDG alignment and then the engagement reporting too. So that's something we're looking at in a lot more detail, but a lot more work to do for sure.
You know, I always find these SDG goals and especially these numbers you put here, they're rather difficult to interpret. So, for example, if you take 5, gender equality. So why did you put 0.2% there, and what does it mean if a company uses 0.2% of its revenue to contribute to gender equality? I mean, I imagine if a company board is 50-50 male, female, then 100% of the revenue contributes to gender equality, right? So what does that mean, for example?
I think that's absolutely. So let me just explain the chart in a bit more clarity. So this is mapping an impact investment portfolio to the Sustainable Development Goals. So for example, just read a couple of examples here. So 8.8% of the portfolio would be positively contributing to climate action. 26.1% would be contributing to good health. So there'll be a mix of which sustainable development goals the companies are contributing to. So at that point, there's obviously a small number contributing to gender equality, but it's a balance, and these segments do shift over time as well. So this is very much the portfolio level contribution. So what kind of segments the portfolio in SDGs, and this would be deployed obviously alongside the typical ESG reporting, the typical carbon reporting that you'd expect as a matter of course, and just this is an additional overlay, additional detail that we use. Okay. So we have 3 more minutes. I'm gonna abuse those last minutes with a question of my own. Since you also had an interesting quote. So you quoted Lenin, and then you start quoting Shell, which is also interesting in this sustainable investing presentation, I think. But you mentioned there's no perfect companies. This is a theme I've seen throughout this day. Previously, there was one lady from BeleggersBeraad who mentioned Rio Tinto. That was a company they absolutely
it's like, it's not the devil, but it's bad. Rio Tinto, the reputation is for mining is, but they're needed for production of batteries or like the minerals they dig up. So is there any companies that are? It seems a bit convenient. You can keep investing in all these companies because they all seem to serve some purpose in a way. So what does that mean for something like divestment? Are there maybe companies that are black, in the sense that you shouldn't invest in them, period?
Yeah. So that's the divestment question is very important. Something that does get raised quite often. So I think as a person who's looked at a lot of these funds, you typically don't see a strong representation of sin sectors in these funds anyway. So you're not going really to see controversial weapons, tobacco, gambling, armaments, etc. And where they do use that engagement story, it's particularly sometimes companies that are on the perimeter of how the industry is changing. For example, Volkswagen could be put forward as a transition story, whereas historically it's been had its obviously governance challenges, reputational challenges, but it's seen as its new initiatives around electric vehicles are seen as highly positive in terms of transition. So they in that framework, it could potentially be put forward and using the tools of engagement to improve governance over time, improve the move towards EV and accelerate that. So I think, it's got to be highly targeted. It's not used as a pretext to invest in any company. I would say the majority of positions in impact investment strategies are more anchored around the solutions thesis that I talked about earlier, where you've got that perhaps clearer story, clearer alignment of the business model with environmental and social outcomes. So I would say a smaller part of the portfolio is used on engagement, but I don't think it should be. I don't think it's underestimated, really. So there are red lines about certain companies that typically not investable, which obviously are in those sin sectors. But where there is an industry in transition, which you could make an argument for many of the oil majors, or indeed where there's transition perhaps in the fossil fuel value chain, the electric vehicle value chain, perhaps the mining value chain, then that's where engagement has real benefits, I would say. But for example, are you going to use the tools of engagement to convince a single asset coal mine to divest its operations from coal mining? Right. It's not going to happen. Yeah. So where it is relevant and appropriate, then I think engagement can be a powerful tool, but obviously it's got to be used sparingly and effectively.
All right. Okay. Thank you very much, Oliver. I appreciate you not coming here, but at least videoing with us. Oké, we gaan verder met de volgende sprekers. Dat zijn Maria Laura Hartpence. Ik zal de titel in het Engels voorlezen. Head of Fixed Income Quantitative Research bij HSBC in Parijs. En Rashida Mourayib, ook Head of Fixed Income ESG and Green Research, ook bij HSBC. Dus dat zijn collega's. En zij gaan met ons spreken over bedrijven, over het financieren van bedrijven die een rol spelen in de energietransitie. En ook voor deze sessie geldt, u kunt vragen blijven stellen in het chatvenster wat in uw scherm, onderaan uw scherm te zien is. Oké. Hey, hello, welcome. Bienvenue.
Hi, merci. Bonjour à tous. Hi everyone.
I've just introduced you to the audience. It was a kind introduction, as always. And, please enlighten us with your information about financing of the energy transition. You have the floor.
Okay, thank you very much. Hi, everyone. So we are here today to present you a new solution we developed clearly to track impact investing, which is our subject today. Climate change has emerged as a secular trend, and it has now widely recognized the world has no other choice but to adapt itself. This is clearly probably the measure point to stipulate. This, as you all know, translates into numerous regulations and high-level initiatives. You all know IPCC, IGCC, and progressively, which are progressively, shaping a world where climate change is set to be increasingly challenged and scrutinized and quantified. At the same time, the current context obviously creates opportunities for solution providers to develop technologies to reduce, avoid, and or capture carbon emission, even if the last one is probably the most difficult. In addition, companies operating in carbon-intensive industry that are transitioning to more green operating practices, we expect them to benefit also from a competitive advantage and higher profitability revenues, as long as they developed and they are clearly in a real transitioning trend. What we try to capture based on this stipulated point, it's today this trade-off between companies mitigating and adapting their activities to reduce their carbon footprint compared to corporate that do not or continue or not on a trend to decarbonize is exactly what insurers, pension funds, or even other asset owners, are increasingly keen to address. And this is typically this kind of climate solution request we receive from several of our clients. This is why we developed this very innovative solution. We can probably move on the slide 3. Thank you. So our approach is based on two measures, I would say basic, but point, which are to ensure the consistency of the financial strategy with the objective of the 2-degree trend. So clearly being in line with the Paris Agreement, and also to support convergence to a carbon neutrality economy by definitely and essentially financing companies engaged in the energy transition. So for that, we created first, we built a portfolio. Sorry, I have just. We built a portfolio around the carbon footprint. Sorry, I have some technical issues. I can't see very clearly the screen. I will just change. So we created a portfolio built around the carbon footprint, as I said, for European individual favoring sectors deemed to have the greatest impact on the energy transition. So clearly, the purpose here is to select sectors that are the most polluted, but for which we are expecting to see a real transitioning trend. This is the starting point of what we created as a proprietary in-house, what we named the climate index. The second measure innovation we did for this climate solution is to develop a proprietary climate scoring methodology that will, in the same way as what we did for the portfolio or the climate index, that will identify the best players in the energy transition. The climate scoring combines quantitative and qualitative information, such as carbon intensity, scope 1, scope 2, scope 3. We will develop this later on, but also avoided carbon emissions, green share companies, exposure to physical and transition risk. This is among the major metrics. I will now hand over to Maria Laura on slide 4. She will develop a bit more the product, the process, the scoring, and also the climate index. Can we move to slide 4? Yeah, perfect, thanks.
Er komt nu een andere spreker. Maria should open her microphone. That's the issue right now.
Yes. Fais juste ça, Maria, soulève.
Attends. Hello, sorry. Yeah.
Well,
yeah. Okay. So, going more into detail to what Rashida started to explain, here in this slide, well, I'm focusing on the strategic sector allocation. You know that the market where we're going to work is the Euro credit market, and the benchmark of departure is the Bloomberg Barclays Aggregate Corporate Index. Okay, so the question is, are we going to use this allocation of sectors of this index? Well, the answer is no. Our sector allocation is going to differ quite significantly from the Barclays index. So our point of departure for doing this is going to be the carbon footprint of an European average individual. This is the graph you can see on the left. On the left, you can see the little man, and here we can say that the emissions of an average European individual can be classified in the following themes: transport, housing, food, consumer goods, and leisure, and services. What is the share of these themes in the total emissions? Here we're talking about direct and indirect emissions. So if you look at food, it represents more or less 90% of total emissions. Housing represents 22%, transport 24%, consumer goods and leisure 22%, and services 13%. Okay, these numbers come from a study, but there are several studies that support more or less these numbers. Now, the sectors of the economy are related by their activities to each of these themes. For instance, if you take metals and mining, this theme, economic sector, is present in transport and is present in housing. If you take another economic sector like automobile, this is going to be present in transport and in consumer goods and leisure. If you take the electric sector, for instance, this is going to be present in various themes, in all the themes except food. Okay, so these are relationships that you observe between the economic sectors and the emission themes. And what is going to happen is the following: the weight of each economic sector in our portfolio. Okay, the sector allocation, strategic sector allocation is going to depend on, for a given sector, is going to depend on how many teams, emission teams, it participates, and the importance of the teams in the final emissions of an individual. So, for a given sector, the higher the number of teams he participates, and the higher the importance of the teams in the total emissions, the larger the weight of this sector is going to be in the final sector allocation. We call this sector allocation, we call it a climate index. Okay? So, can you move to the next slide? Yes, so using this approach, you can see in this slide, the blue bars represents the weight of the sectors, economic sectors, in the Bloomberg Barclays Index. And the green bars represents the weight of our sector, of the sectors in our strategic sector allocation. So the first thing that you can see is that the banking sector has a large weight in the Bloomberg Barclays, which is above 30%, and in our index is much lower. On the other hand, we have some sectors like energy, electric, transportation, basic industry, where the weights in our sector strategic allocation is our climate index is higher compared to the Bloomberg Barclays. Okay, so what we are doing when we are doing this, the intention of this is to finance relatively more those sectors that are relatively more important in the energy transition process. Okay, we can move to the next slide, please. Okay, now we need to choose. Now we need to choose the companies. We need to choose the companies within each of the sectors. What are we going to do for doing so? So you can move to the next slide, please. Okay. So the idea here is we are going to score. We have a scoring method for each of the companies, and the idea is to choose the companies that are have the better score within each sector, the better climate score within each sector. So what we're using here is a best-in-class approach. So we start by constructing a quantitative climate score. You can see on the left of the slide, a quantitative climate score, and the variables that we are going to, the indicators that we're going to use for this quantitative climate score are the carbon intensity, scopes 1, 2, and 3. A rapid reminder of this: scope 1 refers to the direct the emissions of the companies, the direct emissions of the company during its production process. Scope 2 refers to the emissions, the indirect emissions of the company related to the purchase of electricity or steam or gas, the energy it uses in this process. And finally, scope 3 refers to the emissions, the other indirect emissions, which are produced in the rest of the company chain. These measures, we use intensity figures. That is, we take the emissions and we divide by the revenues of the companies. So in that way, we will be able to compare the companies one with another within each sector. The other variable that we use is the company alignment to the Paris Climate Agreement. What is this? In this indicator, what we're going to do is we're going to compare for a given company, the historical emissions and the estimated emissions for a period which goes from 2012 to 2025, okay? And we're going to compare the trajectory of the company with a theoretical trajectory which is consistent with the objective of the Paris Agreement of a raise of the global temperature of not more than 2 degrees compared to the levels observed, the pre-industrial levels of temperature. Okay, so we're going to compare these two figures. Of course, a company where the trajectory is below this theoretical trajectory is doing a good job relative to these goals. Again, we're going to use here intensity figures. And I also want to add that this data is coming from a provider, Trucost. Then we have, if you see the right part of this little rectangle, we have another indicator, which is the avoided carbon emissions, which is simply in avoided carbon emissions, we referred to the avoided emissions that comes because of a choice of a particular technology, an organization of the production process, or the product itself, compared to a conventional situation. So the typical example in terms of product is electric cars. For instance, a company which produces electric cars, you avoided emissions. The avoided emissions indicator is going to compare the emissions, the theoretical emissions of the electric car fleet of the company with a thermic car fleet of the same size. So that would correspond to the avoided emission, the difference between these two things. Again, we're going to use intensity figures. Finally, there is the green share, brown share. Here we are going to look at the activities of each of the companies, and we are going to see what is the percentage of the activities which are more green, and what are the percentages of activities that they are brown. And we are going to compare the companies using this indicator too. The avoided carbon emissions, I would mention that we're using this data is coming from Carbon 4, and the green share, brown share is coming from True Cost. Okay, so this is the quantitative criteria. So what we're going to do is we're going to combine these indicators and produce the climate quantitative score. And within each sector, this is important to say again, it's a best-in-class approach. We're going to rank the companies using this climate score. And we're going to construct an eligible universe where we're going to eliminate the last quartile of these companies. That is the companies that the 25% of companies that have the lowest score. And in that way, we're going to have an eligible universe where the portfolio manager will be able to pick up. But this is a first draft of this eligible universe, because we are going to also look at some, they're going to do a qualitative analysis, and Rashida is going to talk about this.
Right. I think at this point in time, we're after slide 7. So this perhaps there are some questions. I had one myself about this slide. The climate score is composed of 70% carbon footprint and 30% opportunities. So, but why 70-30? I mean, couldn't there be some company? There was an example today of Rockwool. They make isolation materials, so they produce a lot of carbon, but they also save a lot of carbon. But it seems that pillar 1 is heavier weighted than pillar 2.
Yeah, this is a very good question, because it raises a lot of discussions in our team. Actually, these are average values. So the values are not going to be, and we're still discussing of that to because we are launching this strategy this month, and probably those weights are going to change in some way. But basically, I don't know. We really wanted to do so. It's I don't know. We think that the first of all, the carbon footprint data, all the carbon intensity and company alignment. It's true that it's a data that is more, I would say, more robust for the moment, because it has been produced for a long time to begin with, particularly scopes 1 and 2. Scope 3 is another problem, and then the alignment also is something that has been used a lot. And then we wanted really to introduce this measure of avoided carbon emissions, because it's something which is quite dynamic. I can't tell you, there is not a quantitative study that support why it's 70-30. I would say it's just our idea that this is what we should do now. There's not. I don't know if Rashida, you want to add something.
Yes, I would just probably say. This is effectively a good question. We worked a lot on the weight. This is not a finished picture, but for the time being, what we saw is more companies. We have less companies, or we have companies that, yes, showing less, or probably beginning a kind of transition. But we want to definitely capture the impact investing. So we need to track the ones that emit the more, and see how going forward and in this 2-degree trend, they will definitely confirm their transitioning strategy or not. Is this only greenwashing? So we need really to differentiate companies that are really in a real trend. This is why we will probably try to focus more on where are they today, and what trajectory they will take, and how and this is what we want to measure, because we definitely don't want. This is also why we did this sector allocation. We definitely don't want to invest and to track a bank or companies for which the challenge is definitely not climate change is not a real pure challenge. We want definitely to track and to see over time the ones that will really be in a real trend, because when we also run a lot of various green strategies, and we saw already for ESG, for instance, a lot of greenwashing at the beginning, but also still going on. So we have to be really careful on this.
Okay.
But then when we will see that companies will move to more green and transitioning, then yes, we might revise the weight. But for the time being, this is the...
We have about 10 more minutes, but there's also quite a lot of questions coming up. So perhaps I'll ask one of those questions, then we'll go through the rest of your slides, and then perhaps there will be one more question.
I try to do it shortly, to leave some more
extra
time for questions.
So there's one. I'll just do one audience question right now. It's from Anne. It's from Le Comte. It might be from your area. Basically, you created the climate index, but this kind of strategy can be managed with climate scores only. Is that correct?
That is correct. The climate index, as Maya said, that was created internally. This was clearly to favor sectors for which we expect a real transitioning. But yes, we can definitely run a fund only based on the climate scores.
Okay. And another one is, do you arrive at a higher carbon footprint in your index than the original Barclays index?
Yes, and we're going to show that in a few minutes. What happens is that the temperature, we measure that with the temperature, and there's also the carbon measures, etc. of the climate index, of course, is higher compared to the Bloomberg. And then our final portfolio is trying to achieve with a higher portfolio where we are going to do the selection, which is going to be based in the eligible universe, the temperature and on all the carbon indicators are going to be reduced again. We are going to
perhaps we can definitely move to slide 10.
Okay, sure.
This will definitely shows the clear answer.
This is
slide 10. We will have
this one?
Yeah, this one.
Okay.
This one shows you I
can't see.
This one shows you clearly, for instance, the difference between, in terms, for instance, of temperature. This matrix is definitely important because we will see the trend in terms of the 2-degree alignment trend. So you can see that you have the portfolio temperature, the climate index temperature, and the Barclays index temperature. So the portfolio, the model portfolio we have today is showing better temperature trend than the index, the climate index. But it's true that the climate index shows higher temperature than the Barclays index. But as Maria told you, first of all, the climate index is favoring sector that emits the most, while the Barclays index is probably more concentrated on issuers, banks, issuers for which the temperature is by nature more positive. So we will not necessarily compare ourselves, the portfolio versus the Barclays index, because it will not be the real representation. We will more compare the portfolio with the climate index, which is more in line with this kind of strategy.
Okay. So, but I see here 3.6%, 4.4 degrees. Wasn't supposed to be 2, or just a dumb question?
No, because the idea is to help. Of course, if we are favoring, there is many of the sectors that we have where we have increased the weights. they are not at all in the trajectory, but this is the idea, is to help them to finance them in order to do their transformation. So we are expecting, what we're expecting in the future, I don't know, 3 years, 4 years, I don't know how much time it's going to take, that this thing is going to be reduced. Because if we finance already only the companies that are doing the good job, then all the sectors, because we could have done that. You can choose a sector where the temperature is already very low. And of course, you are going to be in the complying with the Paris Agreement, but this is not the idea. The idea is to finance precisely those sectors that need the most the financing for the energy transition.
But it also shows. Sorry, but it just very quickly, it also shows the fact that for the time being, companies are definitely not in a transition way, because yes, this is. Yeah, I would say the proof that with this kind of temperature, 3.6, it's effectively a bit high, but it also confirmed that, first of all, companies are not yet fully in the transition, changing their business model, changing their unit production, and they will need to finance, but some of them, and this is the one we want to finance, will finance the transition. And from the 3.6 we have today, we expect to definitely go, because there's a timing horizon for this climate strategy from the client that actually ask us to develop this, to definitely be more aligned with the 2 degree temperature.
Okay, thank you very much. So we have, I believe, 3 more minutes now. So what would you like to do? Discuss one final slide or take one more audience question?
Yes, probably the slide, let me see with Maria, but I would probably go to the slide 8, which clearly, this is a kind of summary of
this one?
The slide 8, yes, that one.
No, because it's not 8, it's...
yes, this is that one. So there's here... Yeah, so basically here you have a sum up of this approach, which, as Maria told you, first we exclude. There's a first level which is exclusion, but this is basically standards, I would say, in the market. Then the 2 strategies. So we created this climate score, proprietary climate score, that combine qualitative, quantitative, environmental factors. And the fund, this kind of strategy will capture corporates that are on track within the 2 degree alignment, as well as issuers with high CO2 emission, but also showing real opportunities towards green solution. And next to that, we also, as Maria told you, created a climate index that it's a multidimensional sector allocation, let's say, based on the carbon budget of an individual. And this, we decided just to mention that we decided not to focus on low emission sectors and instead developed a dynamic strategy investing in all sectors of the benchmark, including even the most polluting companies. Okay. And then in this pillar, we didn't mention in the scoring, we just wanted to highlight that we also add qualitative aspect, which are physical risk and transitional risks, in addition to the quantitative aspect. And then the rest will be the fund will apply our internal fundamental credit strategy to run the portfolio with bond picking, with driving by fundamentals based on analyst recommendation, because we will not invest and make a bond picking only on the climate scores. Once we have made this eligible universe, once we have all the climate scores, then we will definitely apply a bond picking based on our experience, fundamental active management. And because at the end, we definitely want to deliver performance.
Thank you very much. I have to stop you there. We're running out of time. I thank you very much for your talk. Je vous remercie à vous deux, Maria-Laura en Rachida. Dat waren de presentaties van E.ON en HSBC.